Amazon just delivered a quarter that nobody saw coming. $155.2 billion in revenue in just 90 days. 100,000 robots deployed, Amazon Web Services surges, the efficiency engine is truly alive. Wall Street called it impressive. The stock moved, the headlines celebrated. But here is what nobody is telling you. Buried inside that report are signals that should make every Amazon shareholder pay close attention. The biggest customers, the ones funding this growth, are quietly building alternatives. Key markets are shifting rapidly, and the stock is now priced with absolutely zero room for error. So before you buy, sell, or hold a single share, you need to see what is actually inside this financial report. I went through every single page, every footnote, and every word from the earnings call. And in the next 8 minutes, I am going to show you the things that actually matter, the numbers Wall Street loved, the cracks they completely ignored, and my honest verdict on whether Amazon is still a buy right now. Let us get right into it. Let us start by looking closely at the absolute headline figures that have been dominating the financial news cycle for the first quarter of 2026. Amazon just posted $155.2 billion in total revenue in a single 90-day period. To put that massive figure into perspective, analysts on Wall Street were modeling much lower estimates, expecting the consumer slowdown to finally catch up to them. But Amazon delivered a clear and undeniable beat, printing 14% year-over-year growth. However, what most retail investors completely missed when reading those headlines is that the growth trajectory here tells a much deeper and more complex story about their underlying efficiency. In the first quarter of 2025, growth was stuck at 9%. Then it climbed to 11%, 13%, and now holds steady at 14% despite the massive base effect. Even more importantly, their operating income exploded to $16.8 billion. That is an increase of 200% year over year, proving that their cost-cutting measures are finally flowing directly to the bottom line. These are not just good numbers. At this massive scale and market capitalization, this level of execution is precisely what separates Amazon from every other competitor in the retail and cloud space. The real question is not whether these numbers are impressive, but rather how sustainable this pace is and what exactly is priced in versus what remains a surprise for the rest of the year. Now let us zoom out and look at the broader picture, because the quarterly number alone never tells the full fundamental story of a business of this size. Looking at the last 8 consecutive quarters, total revenue moved from $134 billion up to $155.2 billion. That represents a very solid 15% increase over a 2-year period, which is staggering when you consider the sheer law of large numbers applying here. Let me walk you through the key checkpoints on this graph so you understand the momentum. Back in the first quarter of 2024, they hit $127.4 billion, which was the post-pandemic dip when everyone thought e-commerce was stalling. By the first quarter of 2025, they reached $136.5 billion, marking a return to 7% year-over-year growth. And of course, the fourth quarter of 2025 saw a holiday peak of $185 billion. Every single quarter in this chart shows consistent, methodical growth. And this is happening while the broader retail and cloud industry is growing at maybe 5 to 10% at best. The question is not whether Amazon is growing. The question is, how is this sustainable? And more importantly, who is paying for it? Because behind every dollar of growth is a customer making a bet on the future, and those bets are critical. This right here is arguably the most important chart in the entire financial report, and it dictates the true valuation of the company. 60% of Amazon's total revenue still comes from one massive segment, which is North America retail. North America brought in $93.1 billion, growing at 12% year over year. Meanwhile, the international segment brought in $31.5 billion, growing at 10% year over year. But the crown jewel, Amazon Web Services, brought in $27.5 billion and accelerated to 22% year over year growth. When you look closely at this detailed breakdown, you realize Amazon is no longer just a balanced, diversified e-commerce company. It is a highly concentrated bet on North American retail funding their massive cloud infrastructure ambitions. And that concentration cuts both ways. On one hand, it means Amazon captures almost all the value from the domestic consumer market. Every dollar spent in this space inevitably flows through their fulfillment network. On the other hand, it means if the American consumer slows down even slightly, there is no other retail segment large enough to cushion the fall. That is not true diversification. That is dependency on the domestic economy. The smart money always asks, what happens when your primary retail growth engine hits total market saturation? That is the real risk hiding in this donut chart. Let us look at exactly how the revenue mix has shifted over the last 5 quarters to understand the internal dynamics of the business. Total revenue grew from $136.5 billion to $155.2 billion. That is $18.7 billion of completely new revenue generated in just 4 quarters. But you have to look at what is actually driving this. Amazon Web Services added $5 billion in run rate revenue year over year, proving the cloud computing market is reaccelerating. Furthermore, North America retail margins hit an absolute record of 6.5%. And perhaps most importantly, their high-margin advertising business is quietly becoming a $50 billion per year juggernaut that rivals the biggest tech monopolies. The internal composition matters just as much as the top-line total. When you see one segment dominating the profit growth while others stay flat, you're looking at a company undergoing a massive fundamental transformation. Amazon is not just growing, it is entirely reshaping what its core business model is. The protective economic moat around the dominant segment is getting significantly wider with every passing quarter. This is the exact moment where most retail analysts make their biggest mistake. They project the dominant trend linearly into the future without looking at the underlying mix. The reality is always far more nuanced. Here is where the financial story gets even more compelling for long-term shareholders. Amazon's operating income in the first quarter of 2026 exploded to $16.8 billion. The margin trend is recovering aggressively, moving from just 5.7% all the way up to this new record level. Operating margins overall exploded from 3.5% to 10.8% in a remarkably short time frame. This was driven by 2 massive fundamental shifts. First, their new regional fulfillment networks have drastically slashed shipping costs across the board. Second, extreme robotic integration has allowed them to reduce their human headcount by 100,000 workers while still fulfilling more orders than ever before. This is the definition of operating leverage. Amazon Web Services operating margin also hit a record high of 37.5%. These are not just standard growth company metrics, these are absolute pricing power metrics. When a company can maintain margins at this level while simultaneously scaling revenue, it means the market is accepting their pricing without any pushback. That is the true definition of a monopoly moat. Competitors can try to undercut them on price, but they simply cannot match the logistics ecosystem, the cloud technology, or the customer lock-in that the Prime ecosystem provides. The margin tells you everything about the competitive position, and right now it says Amazon has 0 real competition. Now let us talk about exactly where this revenue comes from geographically, because the regional split reveals critical insights about their global vulnerabilities. North America completely dominates with $93.1 billion, representing 74.7% of the total business. Europe comes in a distant second at $15.5 billion, which is 12.4%. Asia contributes $10 billion at 8%, and the rest of the world makes up the remaining $6 billion. Here is the massive risk factor that no one wants to talk about. Ultra-cheap Chinese retailers like Temu, Shine, and TikTok Shop are aggressively eating into Amazon's apparel and cheap consumer goods market share globally. In response, Amazon is being forced to launch a discount storefront to fight back, which could compress margins. The concentration here really matters. When one single geography represents nearly 75% of your total revenue, any disruption, whether it is a policy change, a domestic economic slowdown, or new competitive pressure hits you disproportionately hard. The smart investor does not just blindly look at the total top-line revenue. They analyze the geographic concentration, the regional dependency, and the global optionality. Right now, Amazon's geographic profile shows incredible dominance in its primary market, but severe vulnerability and stagnation in its international expansion efforts. Amazon's forward guidance is what separates a good historical quarter from a great future outlook. Their guidance for the next quarter is $750 billion, compared to the last actual full-year revenue of $680 billion. That implies roughly 10% sequential growth, proving the momentum is not slowing down. The full year 2026 revenue is accelerating. Furthermore, the second quarter operating income is expected to hit $18 billion, which would be another all-time new record. However, you must pay close attention to their capital expenditures. They are projecting $60 billion in spending, almost all of which is going directly into Amazon Web Services and artificial intelligence server buildouts. They are also deploying the third generation of their Sparrow robotics to over 500 fulfillment nodes. The chief executive officer's message was incredibly clear on the earnings call. Their regionalization efforts and artificial intelligence-driven robotics have structurally and permanently lowered their cost to serve. Guidance is the stock market's crystal ball. When a massive company guides above consensus estimates while spending $60 billion on infrastructure, it signals supreme confidence in future demand, supply chain stability, and management execution. Amazon's guidance here tells the market exactly where they see the retail and cloud sectors heading over the next 12 months. And understanding that gap is where the real alpha lives. Now, let us talk about the specific risks that keep smart institutional investors awake at night. Number one is the Federal Trade Commission antitrust lawsuit. The current administration's Federal Trade Commission is actively trying to break up Amazon, specifically targeting the Prime subscription bundle and the fees they charge third-party sellers. The key metric you must watch here is breakup risk and regulatory fines. Number two is the threat from Chinese discounters. Competitors like Temu and Shein are currently spending billions of dollars on advertising to steal the low-end e-commerce market share directly from Amazon's platform. The key metric here is market share bleed in the apparel and home goods categories. Number three is the intense cloud competition. Microsoft Azure is currently growing at a faster percentage rate than Amazon Web Services, directly threatening Amazon's long-held status as the undisputed king of cloud computing. The key metric here is the ongoing cloud wars and enterprise contract wins. Every single investment thesis requires a strong bear case. The difference between amateur retail investors and professional financial analysis is whether you can articulate the downside risks as clearly as the bullish upside. These three risks are not just hypothetical scenarios, they are active, measurable, and rapidly evolving situations. The question is not whether these regulatory and competitive risks exist. The question you have to ask yourself is whether they are already priced into the current stock valuation. Here are the absolute key things you need to remember from this entire comprehensive financial report. Number one, the profit switch has been officially flipped. Amazon is no longer sacrificing their margins for top-line growth. They are now extracting maximum profit from the trillion-dollar infrastructure they spent a decade building. Number two, Amazon Web Services is re-accelerating. The corporate cloud optimization cycle is finally over. New artificial intelligence workloads are driving 22% top-line growth and staggering 37% operating margins. Number three, robots are actively replacing humans. Amazon permanently reduced their corporate and warehouse headcount by 100,000 employees while successfully fulfilling more orders than ever before. Artificial intelligence robotics is driving massive operating leverage across the board. Number four, their advertising segment is a $50 billion beast. Amazon's ad business is now growing significantly faster than Google or Meta, operating with essentially 100% gross margins. Number five, massive free cash flow will inevitably drive stock buybacks. With over $55 billion in trailing free cash flow, Amazon is perfectly setting up for a massive capital return program to reward shareholders in 2026. The verdict is a strong buy. Amazon is arguably the most complete and dominant company on earth right now. The trifecta of cloud artificial intelligence growth, retail margin expansion, and advertising profit is practically unstoppable. This is not about predicting the future. It is about understanding the present well enough to position your portfolio for success. So here is the absolute bottom line. Amazon's Q1 2026 delivered financial numbers that demand your attention. $155.2 billion in revenue. The fundamental bull case is incredibly real and the raw data supports it. But the bear case is just as real if the consumer weakens. My official verdict? Strong buy. Amazon is the most complete company on earth right now. The trifecta of cloud artificial intelligence growth, retail margin expansion, and advertising profit is completely unstoppable. This is not the time to blindly chase momentum, and it is definitely not the time to panic. It is the time to be a calculated investor. Now I want to hear from you. What is your personal take on Amazon stock? Drop your thoughts in the comment section below, because I read every single one. If this breakdown saved you from making an emotional decision, hit that subscribe button, because next week I am covering another earnings report that is going to move markets. Until then, stay sharp, stay patient, and keep planting those seeds.